Welcome into America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates. Securities offered through Peak Brokerage Services, LLC. Advisory services offered through the Retirement Guys Formula, registered investment advisor. America's Retirement Headquarters, America's Medicare Associates, and the Retirement Guys Formula are separate and independent entities from Peak Brokerage Services, LLC. Welcome into, and thanks so much for joining us here on America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates with Nolan Baker, Scott Kirshner, and Chaz Price. Myself, my name is Chris Swan. 419-794-3030 is the phone number. Once again, that's 419-794-3030, online, arhq.com. Today on the show, with the Fed looking at cutting interest rates, is it time to revisit your retirement plan? And the father of the 401k is talking about his one big regret with the plan. Also, what can Babe Ruth teach you about lifetime income? All this and more. But first, let me check in and say hello to the guys. Nolan, Scott, Chaz, glad to be with you. How you doing today?
Doing great. So we're just getting through hockey seasons, coming to kind of a close, but had a wonderful season in hockey, and super proud, obviously, of my son for all the great times watching him on ice. But once hockey gets over, I don't know what I'm going to do on the weekends.
Yeah, you're going to be weekend free for a while, which is good because the time of year you come in weekend free is springtime.
That's right.
So that's a good thing. I thought it was softball when my daughter graduated. I thought my traveling with softball was over and done, and it is. But my stepdaughter's doing travel volleyball now, so I'm making that circuit. I got one more year of that, and then I'm going to be like totally weekend free, no travel. I don't know what I'm going to do with myself.
Bachelor pad, yeah.
Yeah, I know.
Kind of. I'm done with kid sporting events these days. My kids are kind of moved on for that, so. My wife and I, we celebrated Valentine's Day. We went to a Harry Potter concert, actually, over the past weekend. It was at the Schuster Center downtown Dayton. It was a really good time. Basically, they showed the movie, and then they had the concert. The orchestra played the score live. Yeah. So we're big, huge fans. We watched all the movies, read the books, got the matching Danny Radcliffe tattoos. So, just kidding. Don't judge, Chris. But yeah, we had a good time.
See, now look, Chris, look what you got to look forward to. I know your son's quite a bit younger, but see what you got to look forward to. We're talking about all of our weekends being occupied with sports and family time, which is always a good thing.
I mean, he's 8. I'm constantly at museums and looking at dinosaurs and Pokemon and things. So, you guys say this. We're going to revisit this conversation, I would say, a year or two from now, and you will find other ways to occupy your time. They're not going to be as free as you think. And it's a good parallel when it comes to retirement. You may not necessarily know what you are going to do in your retirement, but you're going to find ways to fill the time. And here's a secret. It's not really a secret. I think most people will understand. It's going to cost money, and so you're going to need to have a plan in place. That's what we want to talk about here on the show. The team at America's Retirement Headquarters can help you. Again, the number is 419-794-3030. How does the CEO of America's biggest bank position his business when it comes to adversity? JP Morgan Chase's Jamie Dimon tells Yahoo Finance, he looks at how to weather the storms.
I try to run the company such that whatever the range of potential economic outcomes are, we could serve our clients. We'll be there in thick or thin. So I guess my advice is look at a potential range of outcomes and challenge yourself how you feel about if those range of outcomes happened. And so you've really thought it through.
It sounds like pretty good advice when it comes to a business, but in a way, retirement, it's your own personal business. Should it also be how we think about retirement planning?
You really got to know those numbers, and you got to know where things are at and know what we call the guardrails are in your investment portfolio. And if we look at it, right now, in the last week, you had both the Dow Jones Industrial Average and the S&P 500 Index had set all-time record highs. In fact, if you look at things on a global basis, the Nikkei has reached a 34-year high. So you've got a lot of strength in the market, and I hope the market continues going up. In fact, we've had 12 out of 13 weeks. I think it's the most in many decades that the market went up as much as it has here recently. So I hope this year continues to be strong. But if you look at a lot of the forecasts on what the economists predicted the market was going to do this year, we're in a strong pattern right now. So now's the time to take a look at, where you're at in your portfolios and your risk level that you have. One of the softwares that we have talked a lot about is knowing what your investment policy statement is and your risk score. So if you haven't had your risk score done, If you want an independent portfolio analysis, give our office a call. What we can do is we can take your investments, put them into the software, and tell you what your risk number is. And it ranges anywhere from 0, like putting all of your money in the bank, to 100 would be what I refer to as like investing in cryptocurrency. So with our clients, we've got to keep them educated. We've got our upcoming Economic Summit that's coming up here in March. It's where we give our State of the Union address. So if you want to learn about how to position your portfolio in 2024, know where we see opportunities that are out there, go to arhq.com. Click on the events tab for the Economic Summit. But when we're coming up with the risk number for folks, I think right now, what I'm trying to do is identify people that have a risk number, say, greater than 65. And looking at those people that have a risk score greater than 65, getting together, having a conversation with them, or at least evaluating their portfolio and saying, what are the risk metrics that you have in your portfolio? Again, with the markets at all-time high, the flip end of the scale is you have fixed rates at all-time high. Is it time to rebalance the portfolio, or does that risk number really line up with who you are? Because it's important as an investor. Again, if we think of the concepts of being successful in investing, you buy low, you sell high. We've got markets at record level highs. I'm not saying abandon ship or anything like that. Could be a good time for rebalancing, could be a good time to evaluate what your risk is. And when you're looking at the parameters, these guardrails, our software will actually show you within about a 95% confidence level what the range of returns could be in your portfolio over the next 6 months. So if things continue to go up, what your upside potential is, and if things go down, what the downside is. So I think looking at risk right now is very relevant.
Yeah, and what I'm thinking about is, if I'm an investor, and as an investor right now, Nolan, I'm thinking about what are some of the elements of that proverbial storm that our clients should be concerned about, and they're concerned about, and that we're concerned about, and we're talking to them about. First one is inflation, soaring U.S. debt, the upcoming presidential election. I mean, there's a lot of the geopolitical risks alone that see stories about, and so there's just a lot of information out there to be concerned about. So in addition to that, the Fed has been really they're transparent as best as they can, but right now is a tough time to be an investor because it seems like good economic news is bad stock market news, and bad stock market news is good economic news, and it's like what is an investor supposed to think when they're getting conflicting messages like this? So this would be my advice to our clients and to prospective clients. We offer our time and complimentary. It doesn't cost you anything other than your time. But what will help you do is make sure, first and foremost, you have an emergency fund. And I think that's an important step to have to prepare for any financial storm, is build a savings account, money markets, things like that, Nolan, to your point, that are going to still pay you a pretty decent interest rate, but build like a 3 to 6 month reserve for your expenses. That's kind of that cushion to fall back on first and foremost. The other advice that I typically give clients is to trim expenses. It's kind of like, being in business, you want to, it's kind of just being in the game, being in the business long enough, keeping expenses low. I feel like that's kind of a big part of retirement too, at least initially, is dipping into it. Have your mortgages paid off if possible, have your high interest rate debts and credit cards paid off and things like that. That's going to help free up a lot of cash in retirement, so you're not having to worry about selling investments in a down market, basically selling low. That's the exact opposite of what we want our clients to do. And then thirdly, I think one of the biggest risks that clients face right now, that proverbial storm, is inflation. We see it all the time at the grocery store. Prices, these companies are driving the price up of goods and services. And so what I tell my clients is that if these companies are going to be driving the price up, you got to get in the driver's seat. You want to be owning these companies and kind of participating in some of that price appreciation, so that you're actually getting a return of your money back in the form of a dividend. So diversifying your portfolio with a mix of assets and making sure that they're strong stocks that are well capitalized, that have good dividends, I think are going to help reduce your risk of potential proverbial storm in the markets.
When it comes to storms, I can't help but think of one of my favorite quotes. I don't even know who said it originally, but it wasn't raining when Noah built the ark. we may be doing well right now from an economic standpoint, but there's a change coming around the corner soon, and it's better to go have a plan in place now for when the markets do take their downturns, whatever may cause that, so that you're not doing what so many people did in 2020 and then even in 2022, which is selling low and then buying back high. The team at America's Retirement Headquarters can help you with that independent portfolio analysis, start developing that plan. All you need to do to get started, schedule a time to speak with them, 419-794-3030, or going to the website, arhq.com. Earlier, we were talking about, the end of one sports season and the beginning of another. Football, of course, just wrapped up. Baseball, spring training, it's actually underway right now, and it ties into the greatest major leaguer, one of the greatest major leaguers of all time, teaching us a lesson when it comes to guaranteed income. A century ago, Babe Ruth purchased an annuity just 6 years before the Great Depression hit. And as a result, he didn't have to worry about income when he retired in 1935, 6 years after the crash. Doesn't this really drive home, emphasize the benefits of having guaranteed income from things like annuities?
Well, I mean, if you look at it, one of the biggest concerns, I think, for somebody retirement time is outliving their income. Mm-hmm. And so the great thing about an annuity is you can use an annuity and structure it in a way it can be designed to provide you lifetime income. And that's one of the big values of it. And it's something that's been around for hundreds of years. I mean, here's a great example of 1935 when Babe Ruth used one, and it helped protect him against the major crash that we had back in the late, 1929 era time frame.
Wouldn't you have loved to know how that conversation went back then?
Must have had a good advisor.
Oh, exactly. Think about it. Back in those days, it's hard to put ourselves back there, but how did that conversation start and how did that conversation go with whoever was advising Babe Ruth on an annuity and guaranteeing income?
Yeah.
I mean, he probably looked at him like, oh my gosh, this guy's
Partying
got
too hard, babe, you're going to run out of money.
That's right. It would have been interesting to be a fly on the wall in that conversation, right?
Yeah, he definitely had somebody that gave him some good advice to take and, say, hey, this is the money that you need to have reliable income. This is your fund money over here. Let's separate those buckets out. It makes a ton of sense. There's probably a lot of people that are listening to the show or watching this on YouTube, and they probably already own an annuity. And so let me share a quick story with you, and I'm going to call this lady, we'll call her Ruby. So Ruby's not married, has no kids. She's going to retire probably in about 8 years from now. She purchased an annuity a couple of years ago with that exact thought process is, look, it's just me and I need to have security to have lifetime income. And so she had purchased an annuity and we did a review for her. So we did an annuity audit. And folks, a key takeaway here is if you have an annuity, make sure you reach out to us. Let us do an annuity audit. The reason being is with record level high interest rates right now, the offers that are coming from the annuity companies, whether it's a fixed rate or an income feature, are some of the highest that I have seen in over 20 years. So we did the analysis on her annuity and we took a look at it, and her $400,000 annuity in about 8 years when she's 65, it could generate about $32,000 to $36,000 of annual income. We simply did a comparison of what's in the marketplace today, and if she took that annuity and put it in another annuity that offered the current rates today, it was over $50,000 of income.
Wow.
So she's going to have the ability to take and make an incredible upgrade to her account. Or the second option is if she wanted to have some more flexibility, she didn't have to deposit as much money into the new annuity. That could free up some of her money for her fund account. Mm-hmm. So when you're looking at annuities, there's a couple of things that I tend to take a look at. An annuity is an insurance contract. So what you're looking at is how is the company rated? What is their financial rating? The second thing you want to look at is if it's an income that you're looking for, what is the highest income that's offered from the companies? The next is who will do it for the lowest cost possible? What is the cost structure associated with it? And then ultimately, what are the investment choices? So some annuities, they have the ability where they can lose money. These are traditionally known as variable annuities. And so the problem with Ruby in her situation is if she kept her annuity that she has today, not only is the income not the best compared to what she could get in the marketplace, heaven forbid, because she's in a variable annuity, if we had a major market sell-off right now, her annuity value would go down, and ultimately that could force her to be stuck in that product, because if she's going to move it to another company, they're going to look at what is the cash surrender value of the account. And so she moved it in another company while the market was at an all-time high, while interest rates are at an all-time high. She could lock in, that value of what it is today. So again, if you have an annuity and it's more than 2 or 3 years old, reach out to us and let us do a review for you. There's one of two things that could possibly happen. One, we could potentially get you a lot higher growth than what you have today. The second thing is if you're looking for income, we could get you a lot higher income with some of the products that are out there. Or worst case scenario, we tell you, hey, what you have is the best for you in your situation. Right. And then you can just check that box and know that you have it taken care of. But I don't know, do you guys have any feedback when you're talking with clients about, generating lifetime income?
Yeah, I say kind of a similar concepts of what you're sharing today, Nolan, in the sense that annuities, first and foremost, it's kind of like saying cars. There's a lot of different types of annuities. And so I think generally clients tend to shy away or attribute some of the negative aspects of some type of annuities with they get confused with some of the positives that annuities offer. But I think the main takeaway here is that, especially in this example with Babe Ruth, is that having an annuity shows us that it can be a powerful tool to help you continue to spend and enjoy life without having to be worried that you're going to run out of money, and so that you can spend guilt-free. I found that's often one of the bigger issues with clients is that they are fearful, feel guilty spending in retirement, and so having Social Security and guaranteed sources of income like annuities are going to really help remove some of those restrictions, I guess, on your spending habits.
Knowing when to, I don't know if you guys were just guessing on this, but you actually hit it on the head. Babe Ruth didn't just go out and get an annuity on a whim. He was urged by his business manager to do that. He deferred to his business manager. He trusted him to help with those decisions. I'm sure he didn't get batting practice or batting tips from him, but knowing your skill set and knowing what you do know and what you don't know, and then knowing where to turn in those cases when it comes to annuities, providing guaranteed income, protected from market downside, being able to sift through all of them, find out what's going to work best for you can be difficult to do, but the good news is you don't have to do it alone. The team at America's Retirement Headquarters, just a phone call away, 419-794-3030. You can schedule a time for that annuity x-ray, 419-794-3030. It seems like it's no longer a case of if the Fed is going to be cutting interest rates. It's a matter of when, and quite frankly, how many times. That's what Fed Chair Jerome Powell recently told CBS's 60 Minutes.
We have a strong economy. Growth is going on at a solid pace. The labor market is strong, 3.7% unemployment. With the economy strong like that, we feel like we can approach the question of when to begin to reduce interest rates carefully. We want to see more evidence that inflation is moving sustainably down to 2%. We have some confidence in that. Our confidence is rising. We just want some more confidence before we take that very important step of beginning to cut interest rates.
Remember in 21 when he said that inflation was transitory? Anyway, Powell says look for cuts to begin closer to the middle of this year. What should investors consider doing in the meantime before those rates come down?
Yeah, kind of like the perfect storm, I think, to be taking a look at where we're at in today's environment and how, interest rate cuts could impact people's retirement plans. When we look at it, I would say number one is you want to review your current portfolio allocation. What we have here is we have stocks at record high. Historically speaking, when interest rates come down, there are certain stocks that tend to benefit from lower interest rates, right? That could use the borrowing power with lower rates that are out there. So it's very important, I'd say, to know what you own inside of your investments, especially with the market at record level highs. On the flip end of the scale, you've got fixed income interest rates are at record level highs as well. In fact, some of the products that I've seen out there on fixed rates have been the highest in 20 years. So what you kind of want to do is maybe number two is consider reviewing the duration of your fixed income investments. there's literally something called the cost of liquidity. And a lot of people like to have their money liquid. And I think it's important, as you talked about earlier in the segment about emergency funds, maybe money you're going to need over the next 3 to 5 years. You want to have plenty of liquidity there. But for the longer term money, why not put it in a product that you can lock in decade level interest rate highs for as long as you possibly can?
Sure.
And, if it's something that you're not going to need for a little while, you want to review that duration of your fixed income investments. Consider locking in rates for a longer period of time. Number 3, the tip I'll give here is, interest rates are sensitive. So, again, when rates go down, bond prices historically go up. Again, looking at the asset allocation of the portfolio, if rates do come down, it could make the fixed income bond market even more attractive after taking a couple of brutal years of getting beaten up with rates going up. So 3 good tips on, what I would say with how to position your retirement plan when interest rates come in. Anything that you're saying, Chaz, to clients about outlooks and the impact that it could have?
I think it's positive. Lower interest rates for the most part. I know for savers, it was a positive that they could kind of hide out in some of these short duration money market, safer instruments. But I think as those interest rates come down, as you point out, it's going to give an opportunity for maybe some of the money that's on the sidelines to start to enter back into the market. So there may already be some kind of pent up demand for stock, just kind of waiting for the interest rates to come down so that they don't have a choice. And we saw that kind of the better part of the last decade where there was no measurable interest to speak of. So people kind of were forced into stocks, and that kind of pushed the market up. That may have been an impetus for the return, the great returns that we've had. The other thing that I'll say generally is that, we've kind of all have our eyes on the housing market right now with interest rates as high as they are. So I think that may offer an opportunity to kind of pivot into some of the sectors of the economy that haven't participated as heavily in the growth. It's been led by the Magnificent Seven or, the FANG stocks or whatever, acronym you want to refer to these behemoth stocks. But the reality is the market as a whole hasn't enjoyed a whole lot of participation, housing being one of them. So that might be an area where you could maybe speculate a bit with some funds if you expect interest rates to drop.
And at the end of the day, really what it comes down to is what I call portfolio optimization. It's making sure that if you're not going to get up and go to work tomorrow, that your dollars get up and go to work as hard as possible. And the neat thing is with some of the technology that's available, like the tools and research that we use in our investment policy statements, we're able to really take a look at putting that all together to try to get you a portfolio that is optimized, making sure that every dollar is working as hard as possible. So again, if you need to find out, is there a way that you can make your money work a little bit harder? Give our office a call. We'll be happy to put together an independent portfolio analysis for you.
We've spoken many times here on the show against the notion that you can time the market. It's nigh impossible, especially consistently. But this is one of those situations when it comes to these interest rates, they are not just guessing that they're going to come down at some point in the future. They're saying as much. So this is a really good opportunity to see how you can make this work in your favor. The team at America's Retirement Headquarters, they can help explore those options and show you how to make your money work a little harder. 419-794-3030. That's how you schedule a time. It's no secret that people are living longer these days, and that is a great thing. Thanks to medical advances, we're all living longer. But there is a side effect to that. A new study finds that they're spending less time of that longevity actually in good health. The same conditions that used to kill us outright, they're now chronic diseases, something you have to maintain. And it all adds up to higher healthcare costs that can drain down household budgets. So let's talk about this. The I guess the opposite of a silver lining here. How can you plan for this so that retirement savings aren't drained as well?
Well, this is a really hot topic with a lot of people that I meet with on a regular basis. And like you said, Chris, the good thing is we're living longer and get to experience maybe more time with family and grandkids and things like that. But, the downside of it is, living longer with some chronic illnesses might not necessarily be the greatest thing.
I don't know which one's worse.
Exactly. And I don't know if it's because, I turned the big 6'2", and I'm now closer to these longevity and chronic illness issues, but I see a lot of people, I'm looking at things a lot differently now, and I see a lot of people and meet a lot of people that are using walkers and using a lot of treatments and devices and things of that nature just to get by. And if you don't properly prepare for the chronic illnesses and you don't have your long-term care policies put in place to, if you do need to go into the skilled nursing facilities or the nursing homes and get that specialized treatment, it could completely destroy your investment portfolio when you move through retirement. There are so much to be prepared for that a lot of people are not. One of the things that was kind of an echoing theme of this past AEP for me was, people would come in and they say, I love my policy, it's working really well. The problem is my medications are killing me. I mean, the cost of these medications are really, really outrageous. And, I heard on the radio here just the other day where they're talking about all of these weight loss drugs, the Ozempic and Mounjaro, and these medications have really big price tags. You're talking $500, $600, $700 a month for these medications. And a lot of people are using them because they actually help with diabetes. So you have to be prepared for this. And one of the things that you guys do a fantastic job is, Nolan, your independent income system, and it's having those buckets of money set aside to pay for some of these issues, the chronic issues, and having that money in there so you don't deplete all of your income or your fund money, so to speak.
Yeah.
When you look at it and you look at, what are the costs of chronic illness, you can break it down in a couple different ways. I mean, you can have what I would refer to as some of the ones that you can physically add up, the medical expenses, such as what you were talking about with like your treatment. In some cases, chronic illness, it requires even more specialized care. Medications, as you point out, can be extremely costly. The healthcare services, such as, needing rehabilitation, home health care, that can contribute. You have insurance costs. So if somebody can qualify, if they're healthy enough to qualify for like long-term care insurance, that could be an option. But as you point out, your Medicare costs, you have your supplemental insurance, any co-payments, deductibles, out-of-pockets. But there's a lot of it as well that, adds up into that are additional costs. And if you think about it, one is I think about the cost that it takes on the healthy spouse at home. I can think of my grandfather. I mean, he's what I refer to as a man's man, right? He did a wonderful job. And after my grandmother had a stroke, he was the primary caregiver at home for 7 years before grandma passed away. But I can tell you that 7 years, the cost was on his age. I mean, it really aged him a lot being the primary caregiver. You have a lot of adult children that will go help out. And so if you think about that, you've got the productivity cost. Those people, maybe if they're not working full time and they're taking time off work, they're not putting as much money towards their own retirement plan. And they're, missing out on maybe some of the sports events that we talked about earlier. You think about travel expenses. So I think about how much I spend in travel hockey. Imagine, going to different facilities and, what it costs for different travel expenses if you're going to go somewhere else. So these things really kind of add up quite a bit. The thing is there's two types of choices on what you can do here in the situation when you're dealing with the cost of chronic illness. You can break this down into what is called crisis planning, or you can break it down into non-crisis planning. So maybe you've seen a loved one, mom or dad or a family member go through that, and you say, you know what, I don't want to ever put my family through that situation, so I'm going to make some choices today while I'm still young and healthy. There's a lot of choices that are available, whether it's traditional long-term care insurance or other options. In fact, my favorite is showing people how to protect their assets without ever buying traditional long-term care insurance. That includes some of the options like life insurance, that includes chronic illness or long-term care riders on them. That includes some of the annuities that offers higher income payments when you cannot perform some of your activities of daily living. So some of those allow you to kind of start building out a bigger bucket, as you talk about in our independent income system, without spending money on traditional long-term care insurance. At the same point, there's people out there that maybe wouldn't qualify for traditional long-term care insurance. And so I want them to know that there's still options that are available that are out there. One is like what we talked about with Troy, the looking at making sure you have a prepaid funeral arrangement. There's, countable and uncountable assets. Sometimes that's a protected asset from like Medicaid spin down. Some of the annuities that we work with, there's no medical underwriting. So the longer you have that money in place, the bigger the bucket grows for some of the enhanced payout features that are in there. So the sooner you get this going, can help out. And even in a crisis situation where somebody's just going in, that's where we can pull in one of our attorneys that we work with who focuses and specializes in elder care and work on some of the crisis planning solutions that are out there. So my advice, bottom line, is everybody needs to take a look at this. It's not surprising that at the cost today, the average family gets wiped out pretty fast. Mm-hmm. But while you're young and healthy, there are choices that we can take to leverage your existing assets to put a shield around your personal assets in the event that you have some type of chronic illness down the road. And even for those folks that are maybe facing a family member with chronic illness issues right now, before things continue to get worse, it's a good time to have a conversation to talk. That's the advice I'd give.
That's great advice, Nolan. In fact, I'll tell you, I've got several clients with several stories that I could share, but a couple of them I'm going to tell you listeners right now. You could do some soul searching. You can, think, well, maybe though that's not going to be me. If you're married to somebody for 30, 40, 50, 60 years with some of these people, and all of a sudden, your spouse comes up with some sort of a chronic illness, and you're not going to abandon them. It's just not going to happen. And one of the things that's going to happen is it's going to deplete your resources. If you're the caregiver, you're still going to be that caregiver, and you're going to be spending more money on transportation and all of these things. You may need to make your house a little more user-friendly for somebody that can't get around as easy. That money's going to come from somewhere. It will make that whole process a lot more easy to handle and more accepting of both parties if you prepare for that before that happens. And you can basically say, hey, look, honey, we set this money aside for these health issues right here. Let's give you the treatment that you need.
Yeah, I would agree. And I would say also preventative care, Nolan. I know you've explained some of the insurance solutions that we have that don't require fully underwritten long-term care as more of a preventative policy, in the sense that you may just need someone for a period of time, to help you recover from a pretty normal maybe hip replacement or something cosmetic, that absent of having an alternative source of care for that, some income, you may have to go into a facility, which the care may not be as good. You hear horror stories about people going into the hospital and coming out with more conditions than what they had going into it, because there's sickness all around. Whatever it is, but maybe some of these things you want to actually have somebody help take care of you at home and keep you out of the facilities of having to go back. And just kind of look at it from more of a preventative. So I think that's one aspect that clients can take, is looking at their the chronic illness as a preventative sort of some steps that you can take to at least limit or reduce the expense. The other thing is, too, me personally, recently, hitting 45, never had medication before, was first faced with having to take some medication, and the price tag without, like these GoodRx and some of these coupons was like $80. In addition to that, if you go to Walmart, it was like $57, but then with Rite Aid and the GoodRx, it was $5.
Yeah.
Like, how is that legal? What's going on? And that's why I love what you do, because I sit right next to you. I've heard you go to bat for some of these clients. Like, no, that's covered in the XYZ. That's why I give that to you. Mm-hmm. And they're always coming down on top. There's always, it feels like if you don't have an advocate on your side, you can get, plowed over by some of these insurance companies. And so having a person that you can sit down with, I think, is very important, as opposed to getting on the phone or clicking a button and doing it online and never meeting this person, not actually having somebody hear your story, or better yet, care.
Right.
And I think that's what we do really well here, is we care, we'll go to bat, and we, we'll try to save you as much money as possible because otherwise it's not going to happen.
You know, it's not just a person. It's the entire team at America's Retirement Headquarters, both Retirement Guys Formula and America's Medicare Associates. When it comes to healthcare expenses you could potentially be facing over the course of your retirement, think of having a plan in place kind of like a fire extinguisher in your kitchen. You certainly hope you don't have to use it, but if the situation does arise, you're going to be pretty glad that it's there. So pick up the phone, schedule a time to speak with them, and start developing that plan. 419-794-3030. The website, arhq.com. Lots of events going on throughout the region. You can find out more about them and go and reserve your seat by clicking on the events tab over there at arhq.com. A lot of hotel chains have tried to be more transparent over the past couple of years by removing any hidden junk fees, but an article on thestreet.com says some of those exact same chains, they're now charging a parking fee to guests regardless of whether or not you actually have a car on the property. And most customers aren't finding out until it's time for that final bill. So you could say that the fee structure changed. And I have to wonder, can the same thing happen to fees when it comes to investments? Can they change within the small print from year to year? How do you guys help investors understand where the fees may lie?
Well, you know, I'd say that the first thing is in that example, they talk about a parking fee for guests, whether they have a car or not. The most important thing in the lesson there is look at your statement. I mean, I'm notorious. I'll leave a hotel and I'll just check out. But, you know, look at the statement and see what it is. The same can be true when it comes to understanding your investment fees and expenses is look at your statement and take a review to see what fees and expenses are coming out. A lot of the times, though, it is much more difficult in an investment portfolio because a lot of these fees and expenses are buried in, and the end user, the consumer, doesn't really understand what they are until they get together with somebody like us and we break it down. So if you want to know what your fees and expenses are, the first thing that you should do is reach out to our office, give us a call, and we'd be happy to do a portfolio analysis, and we can kind of show you what your fees and expenses are down to the penny so you know what your cost structure is. The second thing, as I would say, is the cheapest isn't always the best either. So there is something to be said about paying for something, but again, you've got to get more value in return than what the cost is that's associated with that expense. But understanding what your fees are is crucial. When you look at fees in the financial investment world, the first thing is you have expense ratios, and expense ratios are what we think about when we think about mutual funds, exchange traded funds. Those expense ratios represent the annual cost of operating the fund. These are ones that are typically buried in, so it's one of the ones that's more difficult to find. Management fees. Some investment funds, particularly actively managed funds, charge a management fee for the professional management of their fund's portfolio. This has become more popular, I would say, in the last 10 years as people, professionally manage portfolios and charge management fees. These are typically ones that are more disclosed. These are ones that you can typically see printed on the investment statement. Some investments have what's called front-end loads. So something like a Class A mutual fund sometimes could carry a sales charge up front. Some investments have back-end loads, like Class Bs traditionally have a back-end sales charge. If you redeem your shares within a set number of years, that fee could kick in. You could have transaction costs. These could be costs associated with like buying and selling securities within a brokerage account. This is an area where I've seen dramatic improvement over the years. I think, when I got into the business 30 years ago, it was expensive. Every time you bought or sold a stock, you'd have $30, $40, $50. There were some of these online providers that came out that started lowering it down to $9.95. And, the companies that we work with today traditionally don't charge transaction fees. People can buy and sell as often as they want, using securities or ETFs without transaction costs. But that is one that does apply in different situations. Advisory fees are somewhat similar. Sometimes they're, like I was referring to, management fees. You could have wrap fees, which are also kind of similar. There's something called custodial fees, so that's what the company could charge you for holding your account. Different investments have performance fees. There's account maintenance fees. There's riders costs and associated with it. But by doing the independent portfolio analysis, then you really start to know what your total expense is. And I would say a lot of the times when people come into our office and we haven't met with them before and they bring their investments in, they're oftentimes pretty shocked at what the expenses are. I think, as an example, variable annuities, in my opinion, tend to be some of the more costly products that are out there. Some of these private investments that are out there, like real estate investment trusts that are non-traded, a lot of these things tend to have more fees and expenses that are associated with them. And they're sometimes hard to find. Oftentimes, I think people feel that they're hidden in there, but we can kind of break those down. I met with a lady recently, and we looked at her portfolio, and I think her goal was to try to earn 6% on average is what she wanted to try to earn, which I think is realistic. But when we looked at the cost associated with her variable annuity, she had a mortality and expense ratio of 1.3%. She had a rider cost of 1.25%. She had a sub-account management fees in the account of probably add another one. All of a sudden she's over 3% in total expenses. So each and every year, regardless of what the market does, the expense ratio was eating up half of her target return. So wow, pretty costly product. But by shopping it out and showing her what is out in the marketplace today, and there are companies that are much more cost effective, we were able to reduce her expense ratio and still get her some of the same benefits that she was looking for.
Yeah.
15 minutes saving you potentially thousands of dollars sounds like another familiar company. Not going to mention them. Don't want to draw their fire, but it is not to say that all fees are bad. You just have to be able to assume or assess whether or not they are of value to you. And if you don't know how much you're paying, well, that is impossible to do. Let the team at America's Retirement Headquarters shine a little light on that. And if you decide it is not of value, maybe explore other alternatives. So the phone number, 419-794-3030. Go ahead and take the time. Schedule that call, 419-794-3030. Guys, let's go back to 1978 when a man named Ted Benna developed the idea of the 401k. 5 years after that, it became a way to replace the pension and for people to save for retirement on their own. At first, the headlines were glowing, but eventually they turned critical, and the Wall Street Journal actually wrote in 2017, quote, "The great lie is that the 401k was capable of replacing the old system of pensions, and it was oversold." Benna is pleased that workers have accumulated $15 trillion in 401ks, fair credit to everyone. But one of his big disappointments stems from Wall Street's takeover of the 401k, which is now closely tied to the $60 trillion mutual fund industry, with fees, like we talked about earlier, once paid by the employers, getting bundled and dumped on employees. So should you, all this said, should you still consider using the 401k in retirement, or is it time to get out of it?
That's a fair question when you take a look at it. And I think, the challenge that you have today is in the pension plan, people would work for a company, typically work there for a long time. They'd retire and they'd have a great steady income for the rest of their lifetime. And if they chose a survivorship option, they could protect their spouse. And, nowadays the majority of the money is in the 401k plan, and most of that's subject to the lottery of the returns of the stock market, and people get really nervous. For younger workers, what I would say is, absolutely put as much as you possibly can to get the company match. In fact, I think all workers should put as much money into the 401k if there's some type of company match. But when you get over and above that, you kind of want to look at some other factors to consider, things like, sources of reliable income. If a 401k, if your investment choices are limited to only things that go up or down with the stock and bond market, you may want to evaluate putting money into something that could be providing more reliable income in the future and help supplement the withdrawals that you're going to take from your 401k. You also have to look at tax consideration. This is a big one. A lot of people are putting money into a 401k in a pre-tax basis. So they're saving a little bit of money in taxes today, and then they're going to pay taxes in the future when they take the withdrawal out. The assumption is when you retire, your tax bracket's going to be lower. And if you look at the financial health of the United States with our national debt and unfunded liabilities, as well as the fact that you're saving and investing to grow the dollars, for many retirees, their tax rates are not lower in the future. So from a tax consideration, there can be other things that could be more tax favorable to save in the future. Things like a Roth IRA is a great complement. Investment selection, if you feel like you're kind of limited on the choices. Sometimes your withdrawal options are difficult. So most of the time, a 401k, you're going to have to leave that money sit until you're 59 and a half or 55 in some plans. But if you take a withdrawal early, you could be subject to additional taxes and early withdrawal penalties. So not having an emergency account build up would be another risk because of the limitations that you have within the withdrawals. Some of the plans that are out there, especially when you have smaller companies, the smaller plans tend to be more expensive. So it really, again, it comes down to kind of evaluating what your individual goals are, and that's going to help you figure out whether you should leave the money in the 401k. Option 2 is roll it over. Number 3 is look at annuity payment options, setting up, or number 4, systematic withdrawals, or taking a lump sum distribution, considering moving your money to like a self-directed type of an account. If you take a lump sum distribution and the money comes directly to you, that could have significant tax consequences. So if you have a 401k and you're putting more than the company match, or if you have an old 401k and you don't know what to do with it, give us a call. We'll help kind of guide you and put together an independent portfolio analysis for you.
Obviously, any money saved towards your retirement is a good thing. It's better than nothing. But you don't want a better than nothing retirement. You want something that is going to work as hard for you as you've worked for it. And that is where being able to review these options, see if there is a better way, comes into play. That independent portfolio analysis available by giving a call and scheduling a time to speak with the team at America's Retirement Headquarters. Once again, that number is 419-794-3030. You can always find them online at arhq.com. Want to thank you, as we always do, for joining us here on the show, spending some time with us here on America's Retirement Headquarters. Hope you have a great week ahead of you. Hope everyone stays safe out there. Gentlemen, as always, it's a pleasure. Thank you for taking the time. And as we wrap up, want to leave you with the final word.
I'd say a lot of great events coming up. So arhq.com, click on the events tab. We'd love to have you come out to our economic summit or one of the other upcoming events that we have. And just remember, when you think retirement, think America's Retirement Headquarters. It's home of the Retirement Guys Formula and America's Medicare Associates.
America's Retirement Headquarters is located at 1700 Woodlands Drive in Maumee, Ohio. You can reach them by calling 419-794-3030 or online at americasretirementheadquarters.com. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Nolan Baker is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstance. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Nolan Baker, Ohio Insurance License Number 27787.